This is Nick Langley, CIO of Rare Infrastructure, talking about the valuation pack for the quarter ended 31 March 2019. So what a quarter it was. We had a pretty poor Q4 of 2018 and caught the rebound in Q1 of 19. And so where we saw a sharp rise in the forward-looking returns across each of the strategies last quarter, we've seen that reverse through the course of Q1. If you take a look on slides 5, 6, and 7, which are the expected returns from each of the value, the income, and the emerging market strategies, you can see a sharp hook down in the forward-looking returns. It's about 300 basis points from last quarter to this quarter. And when you think about that, that's 300 basis points per annum over a 5-year investment horizon. You're talking about a 15% average price move across those stocks. So it's been, it's a pretty significant period of volatility. If you take a look at slide 11, where we see the multiples across the different sectors and regions, actually hasn't moved that much on a multiple basis. We are starting to push up around the top end of what we would consider to be fair value, though, and you can see on slide 12, comparing to last quarter, the forward-looking returns have come in a little bit, and we've seen a couple of sectors tip over into the red, in particular in the US and in both the water and the communications. With bond yields coming in from the end of last quarter, and that's been a key driver of some of the push higher in valuations. With those bond yields coming in, it has reduced the cost of equity a little bit, and arguably with the lower bond yields, you should see higher multiples, and I think it's becoming consensus in the market that we're not going to see bond yields at kind of pre-GFC levels again anytime soon. So that's really starting to have an impact on the way people are looking at these stocks in the market. Let me touch on the broader multiples. Slide 18 is a good one there, and you can see that little hook higher through the course of Q1 really takes us up to about 11 times for the universe as a whole. And I'd argue, that's getting towards the top end of the range of fair value. And you can see each time it's pushed significantly above 11 times, we've seen a pullback. So that's something to keep an eye out for as we move through the rest of this year and into next year. But interestingly, the push higher is really coming from the utilities. Take a look on slide 19. You can see that the infrastructure is still looking relatively contained from a multiple perspective. If we see a resolution on US-China trade issues, you may see those valuations actually push a little bit higher, which could take the sector above 11 times. So that's one thing to look out for. But it's really the utility companies that have continued to grind higher, and that's a combination of factors actually. Take a look at slide 21, where we look at each of the electric, the gas, and the water. And we can see the electric, first of all, has ground higher over the last couple of quarters, and that really is a bond yield discussion, right? So that is the market starting to price in lower bond yields for longer, reasonable growth coming through in the rate bases for those companies, and they're willing to pay more to get access to that defensive exposure in the market. The electric companies really are the most defensive stocks. Water has popped higher, and that's a couple of things going on there. Recovery in some of the US names, but also in the South American names. There's been some recent progress in regulation and potential privatization or further privatization coming down the pipes, excuse the pun, for those names, and that's really pushed them higher in the markets. Sabesp, for example, up over 40% over the last 3 months. That's a Brazilian water utility. The other one that's interesting is the gas names. particularly the US pipelines. Rare has a big exposure here in both a value strategy and the income strategy. It's been a key source of the returns over Q1, with significant names like Kinder Morgan, like Williams, like Enbridge, up 20, 30 and beyond percent year to date. So, recovery there, and that's about the market beginning to recognise the franchise value in those companies and their ability to produce steady cash flows over a long period of time. So broadly, what we're looking at the moment is, as bond yields have ameliorated, that's allowed the multiples to come a little higher, particularly on the utility side. In the next couple of quarters, watch out for that China trade deal. We think that'll come through this quarter or early next. And that could see a pop higher in some of the economically sensitive names. But we would then be starting to call the sector, on the wrong side of fair value at that point and the fair value range. So let me finish there. It's Nick Langley, CIO of Rare Infrastructure, just talked about the valuation pack for the March quarter 2019. Thank you.